On its final night, Silicon Valley Bank hosted VC Bill Reichert's presentation on how to pitch your wow to investors to around 45 to 50 people, including HCare Health CEO Roger Sanford and OmniLayers CEO Mike McAvoy. According to McAvoy, the atmosphere was eerie and many attendees looked subdued. The following day, the bank was shut down by regulators due to a bank run, where depositors attempted to withdraw all their money at once, but the bank didn't have enough cash immediately available. This event led to the second biggest bank failure in U.S. history, after Washington Mutual in 2008. While the situation is complicated, it ultimately boils down to a bank run and the bank's inability to meet the demand for cash due to prior decisions and circumstances. Silicon Valley Bank, established in 1983 during a poker game, was a vital financial resource for the tech industry and was ranked the 16th largest bank in the U.S. before its eventual collapse. Despite the glorification of tech geniuses, money was actually the driving force behind startups, and Silicon Valley Bank provided that necessary funding. With a reputation as the financial partner of the innovation economy, and the go-to bank for investors, Silicon Valley Bank was a popular choice among VC firms, tech executives, and even the parent company of the website the reader is currently on. However, the bank's downfall occurred rapidly in under 48 hours. As for the customers of Silicon Valley Bank, their accounts were insured by the FDIC, which has provided insurance for banks since the Great Depression. Nevertheless, the FDIC's insurance policy only covered up to $250,000 per account. In the context of companies, $250,000 may not be sufficient as many businesses have high monthly expenses. According to a regulatory filing from December 2022, approximately 90% of Silicon Valley Bank's deposits were uninsured. The exact number of uninsured deposits at the time of the bank's collapse is unknown, according to the FDIC. The impact of this can be significant, as even minor disruptions to cash flow can have major consequences for individuals, businesses, and entire industries. While uninsured depositors may eventually be compensated, the problem is that they currently do not have access to their funds. This is causing problems with payroll, and some companies, like payroll service company Rippling, have already had to inform their customers that paychecks may be delayed due to the SVB's failure. This is causing difficulties for some employees who rely on their paychecks for essential expenses such as rent, groceries, gas, or childcare. The challenge lies in accessing funds, which is particularly difficult for startups. According to Gary Tan, CEO of Y Combinator, 1/3 of the companies associated with the organization will not be able to pay their employees in the next 30 days. This can be a nightmare for most firms, as sales cannot be made if sales representatives are not present in the office. Some investors are providing loans to their companies to cover payroll costs. For instance, Penske Media, the largest investor in Vox Media's parent company, indicated its willingness to provide additional funds if required. This is crucial because Vox Media has a significant amount of cash deposited in Silicon Valley Bank. However, investors themselves were also banking with SVB, presenting another problem. The issue of access to money affects not just payroll, but also other expenses such as payments to software providers and cloud services. Although SVB's failure was not directly linked to the crypto market's downturn, it could potentially make the crisis worse. For instance, Circle, a crypto firm that operates a stablecoin called USDC, had $3.3 billion of its cash reserves held at Silicon Valley Bank. When SVB failed, USDC's value dropped below $1, causing Coinbase to halt conversions between USDC and the dollar. However, Circle announced on March 11 that it would cover any shortfall using corporate resources, and the stablecoin's value mostly recovered. The bankrupt Silicon Valley Bank has left some companies and investors with their funds inaccessible. The collapse of the bank has particularly affected startups, with some being unable to make payroll. The failure of Silicon Valley Bank is not directly related to the crypto meltdown but may worsen the crisis since crypto firm Circle's stablecoin, USDC, backed with cash reserves, was stuck at the bank. The FDIC has created a new entity, the Deposit Insurance National Bank of Santa Clara, to handle insured deposits for Silicon Valley Bank. The FDIC's primary role is to get the maximum amount from the bank's assets, which could be sold to another bank to ensure stability and public confidence in the U.S. banking system. If the acquisition of SVB doesn't happen, the FDIC will sell SVB's assets over a period of weeks or months and use the proceeds to repay depositors. Uninsured deposits are high on the priority list for repayment, after administrative expenses and insured deposits. Although a sale may not happen soon, customers will likely get their money back as long as they can remain financially stable while waiting. The current situation is not just limited to startups and Silicon Valley investors. Low interest rates since 2008 have led to a venture capital boom and questionable investments such as WeWork, Theranos, and Juicero. The pandemic exacerbated this trend with the Federal Reserve implementing a 0% interest rate policy, ZIRP, leading to a surge in meme stocks, cryptocurrencies, and SPACs. For banks specializing in startups, the recent annual filing from SVB showed an increase in bank deposits due to the frenzied activity of IPOs, VC investments, and SPACs. To put it simply, Silicon Valley Bank made a lot of money when startups were doing well and cash was flowing, but they struggled to make money off loans because their clients didn't need them. So, they invested in government securities to make up for it, but this meant they were vulnerable if interest rates increased. When interest rates did rise, the value of their assets decreased, and they found themselves in trouble. The recent collapse of SVB was caused by a bank run, and the situation was made worse by the fact that many startups struggle when interest rates are high. The problem was compounded by the fact that short sellers who predicted the collapse won't be able to profit because of the difficulty in collecting their winnings. Did Silicon Valley fail to cooperate in the prisoner's dilemma game? However, the mismatch in risk by itself did not lead to the bank's collapse. Rather, a bank run caused the bank to fail, and unfortunately, there was no George Bailey to prevent it from happening. The bank run happened when interest rates rose, causing VCs to stop investing as much and startups to withdraw more money to pay for expenses. SVB had to come up with liquidity to make this happen, so it sold $21 billion in securities, resulting in a $1.8 billion after-tax loss. It also planned to sell $2.2 billion in shares to strengthen its position. However, Moody's downgraded the bank's credit rating. On a single day, customers tried to withdraw a quarter of the bank's total deposits. In a slide deck explaining the situation, Silicon Valley Bank claimed to have ample liquidity and a strong capital position. However, investors were already spooked by the collapse of another bank called Silvergate, and so when the bank made its announcement on March 8, people began to pull their money out. This included investors such as Peter Thiel's Founders Fund, Union Square Ventures, and Coatue Management, who advised their portfolio companies to withdraw their money as well. In less than 2 days, a bank run occurred, and it can be attributed to the speed of digitalization. Previously, customers had to physically visit a bank or call to withdraw their money, giving banks time to react. However, with digitalization, money was withdrawn quickly, leaving Silicon Valley Bank helpless. On March 9, customers attempted to withdraw $42 billion in deposits, which equated to a quarter of the bank's total deposits. The bank's attempt to sell shares was cancelled, and it tried to sell itself, but regulators intervened the next day. Greg Becker, the former CEO of Silicon Valley Bank, was a director of the Federal Reserve Bank of San Francisco until shortly after the bank's failure. During the bank run, the CEO of Silicon Valley Bank, Greg Becker, urged VCs to remain calm and support the bank, but his communication was ineffective, and his attempt to tell people to calm down only made things worse. Despite this, Becker was the driving force behind the bank's asset sale and share offering plan, which was not the only option available to the bank. For example, it could have borrowed funds or offered favorable deals to depositors who remained with the bank. Furthermore, Becker sold $3.6 million of shares in the bank's parent company on February 27, just weeks before the bank run, and this suggests that he was aware of the bank's financial situation and the potential impact of rising interest rates. The reason why the venture capital industry exists is because traditional banks used to refuse to lend money to startups, who often lacked sufficient collateral for a loan. Silicon Valley Bank played a significant role in supporting startups by providing risky forms of financing, such as lending against accounts receivables and future revenue, as well as venture debt that uses a VC investment as collateral. This type of financing helped turn Silicon Valley into a powerhouse, according to Jonathan Hershen, a high-tech PR expert. Additionally, SVB would obtain stakes in companies as part of its credit terms, which allowed it to profit from IPOs, such as making $13.9 million from Fitbit's IPO. In recent news, Coinbase's IPO documents revealed that Silicon Valley Bank had the option to purchase more than 400,000 shares at $1 per share, which turned out to be a lucrative investment as Coinbase's shares closed at $328.28 on the first day of trading. Startups are not the only entities that need to raise funds. Venture capitalists also require financing, often from family offices or governments. Silicon Valley Bank has invested in a number of venture capital firms, such as Excel Partners, Kleiner Perkins, Sequoia Capital, and Greylock, over the years. One of the issues facing SVB is the insular nature of Silicon Valley. While this made it the go-to bank for tech and life sciences startups, it also limited its portfolio's diversity. The small-town nature of Silicon Valley means that gossip is a popular pastime, and everyone is interwoven. This situation has increased the possibility of a bank run at SVB compared to other banks, as rumors are flying in WhatsApp group chats with founders looking for cash. Scammers may also attempt to exploit this situation to defraud panicked technology brothers for more money. The current situation's outcome is uncertain, and it is unclear whether SVB's leadership was solely responsible for the failure. This is the second significant bank failure in a week, indicating that regulators may have been negligent. The Federal Reserve was the primary regulator for both banks. Thanks for watching. Please like, share and subscribe.